from next month. But in the meantime, let's discuss all this with David Dietze. He's the founder, president, and chief investment strategist at Point View Wealth Management. David, we're nearly at the half-year mark. If you take the pandemic into account for these 2 quarters, what for you right now is overbought or undervalued?
Thank you, Christine. Happy to be back with you. So I think that some of the most overbought areas of the market is really some of the stay-at-home trade. Those would be your cleaning supplies, your Clorox types of things, your food delivery, for example, Domino's, and then some of the internet companies which we've used more of just because we're staying at home and we don't want to leave the house to go make purchases. Amazon comes to mind. Indeed, there's one subset that's really gone out of sight. It's some of the cloud plays. There's several cloud plays that are up about 20% the last month and are trading now at 30 times, not earnings, Christine, 30 times revenues. And I mean, we just heard from Oracle recently that some of its customers are asking for new terms in terms of using its cloud services. So you can't just operate in a vacuum and keep going up without any regard as to the health of your customers. So that's one area, some of those tech and cloud plays that we're just a little bit cautious on.
So, David, should we be considering a redefinition of valuation? I mean, at the end of the last quarter, we had big names like Credit Suisse and JP Morgan reminding investors the fundamentals remain weak. So this pandemic momentum is not a safe bet, and we're going to get another quarter of predictably dismal earnings with zero guidance. How do you make a sound investment decision at times like these?
Yeah, so you're absolutely right. So we're, reaching the end of Q2, and then we're going to get all these reports from the companies, and we think it's going to show earnings down 44%. So, you're right. You're exactly right. How do you reconcile a market that's gone up 40% since March 23rd with earnings that are going to be some of the worst since 2009? And I think how you reconcile is that stocks look out for a long period of time. They're not just focused on what happened in the rearview mirror, but looking at earnings for the second half of this year, 2021, 2022. I mean, how do I tell a client to not buy Apple, for example, is trading at 21 times next year's earnings just because the first quarter, 1 quarter out of the next 84 quarters, doesn't look so good. I think stock investors are taking a much longer view, and they also believe that the reason for the downturn can be fixed. As we develop new therapeutics, vaccine, and testing materials. It's a solvable problem.
David, are you, in your advice to your investors, recalibrating your terms for valuation, your conditions for valuation?
Yeah, absolutely. Because I think, here's the thing, one of the overriding factors for why we have seen this huge rebound from March 23rd is the Federal Reserve. And it has told investors and the public in not so many words that they are going to do whatever it takes to make sure that no company, no consumer, nothing is left behind as a result of COVID-19. As a result, they pushed interest rates down to zero. They're buying up treasuries, mortgage-backed, even corporate bond ETFs. Now, on last Tuesday, they said they're just going to pick up their own corporate bonds, plus even junk-rated bonds. Well, the mathematics of investing is as that discount rate moves towards zero, there's no discounting of earnings through perpetuity. And so you could see a situation, we're not necessarily forecasting it, where valuations ultimately exceed what we saw in the dot-com bubble in 1999. Although they should be worrying about inflation, the fact of the matter is anything COVID-19 will trump any concerns about inflation, their balance sheet, anything, because they're determined to not allow COVID-19 to take down the U.S. economy.
So, David, when it comes to the U.S. Central Bank and the Treasury Department unwinding this unwieldy portfolio, I mean, that's going to be a whole other episode. Let me ask you now, with central banks from the United States to China still continuing to shore up liquidity for the market, what is the danger with this at this time? The fundamentals economically and those conditions now are not like what we saw at the end of the global financial crisis. Banks were not lending at that time. They were hoarding all that excess capital. Now they are potentially putting all that liquidity in the hands of individuals.
So the real risk is ultimately kind of an inflationary risk where you have consumers coming out of their caves as they feel better about dealing with COVID-19 and feeling that they can engage with it because they know how to do that. So they're starting to go out and spend, and we saw a big rise in expenditures in May relative to April. Yet at the same time, Jerome Powell is figuratively wearing a mask and keeping interest rates down. And so you could have a situation where the economy really starts to overheat. Now, at some point, the piper has to be paid, but no one cares about that right now. They just want to get past COVID-19. Just like once we get past COVID-19, there'll be COVID-20 and 21. No one's worried about that right now. So that's the case for some bullishness because they'll keep the interest rates down too long, and ultimately that's going to cause corporations to borrow more and more. They'll start to buy back their stock. They'll make all sorts of investments. They'll get America back to work. And so you could have this window where valuations start to expand. We'll see.
So if market watchers around the world share that view you just laid out for us, how does it change their assessment of the emerging markets? I mean, are there any growth sectors here that are of interest for you with that context?
Well, so the emerging markets actually could be a pretty solid play for two reasons. One is they're heavy debtors. And so to the extent that Jerome Powell wants to make it easier to borrow money for U.S. consumers to buy homes and companies here to expand, that will benefit other U.S. dollar debtors overseas. So they're an ancillary beneficiary. Plus, I think ultimately, to the extent that overseas economies pick up, the dollar has been very strong. We have seen it start to weaken in the last 6 weeks. In fact, some economists think we could see a big fall in the U.S. dollar. To the extent that emerging markets debt is measured in dollars, the burden of that starts to go down, and that could be a tailwind behind those economies. And of course, remember, we're still growth challenged here. We're population growth challenged, and a lot of the emerging markets are growing much faster. And so ultimately, they have some very strong fundamentals. And again, we were talking about valuations just a minute ago. Their valuations are a good 30 to 40% less in terms of price to earnings, in terms of dividend yields relative to the United States.
Absolutely fascinating conversation. Let's get you back on again. David Dietze, thank you so much. Founder, President, and Chief Investment Strategist at Point View Wealth Management.